I've researched 5 online brokers: Avanza, FlatexDEGIRO, Interactive Brokers, Nordnet, and Robinhood. I'll start with an industry overview and then I'll compare the top 4 brokers' performances against each other. After that, I'll go more into details of each broker and I will create valuation models. In the end, I'll also give my opinion about Robinhood and I'll conclude the video by disclosing the investment or trade that I decided to make. Online brokers are great businesses as they can grow in 3 different ways without spending any capital. The sources of growth are from customer acquisitions, customers' assets appreciation, and additional savings capital from existing customers. On top of these growth areas, brokers can still have high dividend payout ratios, leading to extremely attractive investment proposition. I'll talk about all of those 3 growth areas in more detail and try to deduce what are the expected growth rates going forward. First source of growth is from new customer acquisitions. There is a long-term trend of people doing more personal investing. Reasons for it are, for example, uncertainty related to future pension obligations, easier access to investing, 15-year-long record bull market, living in zero interest rate environment so bank deposits didn't earn you any yield, and overall more knowledge about investing. On top of the positive investing trend, online brokers have also grown by taking away customers from traditional banks with their lower trading fees and superior product offerings. The dominant online brokers with large brand awarenesses can grow their customer base without doing any advertising, as many of the new investors get recommended to use these platforms by their friends and family. In the recent years, the new customer acquisition growth rate exploded as people were stuck in their homes with lots of money that they couldn't spend by going to holidays, restaurants, shopping malls, casinos, or whatever, so they started investing. Some people actually invested the money in smart things like S&P 500 index funds or individual companies that they liked. However, many people just wanted to gamble on crazy things like cryptos, options, overvalued technology companies, meme stocks, etc. As the new capital flew into these assets, the valuations went up, which led to even more people wanting to invest in those things, leading to this positive feedback loop. All of the online brokers saw massive customer growth in the past 3 years, but now as the stock market is not so hot anymore, inflation is high, and savings rate is low, the new customer acquisition rate has slowed down significantly. We'll see how many of those pandemic-era investors will be good long-term investors and what percentage were just gamblers who will quit investing once they lose significant part of their capital. One thing is for sure, the customer acquisition rate will slow down in the coming years. Second source of growth comes from customers' portfolios appreciation. However, we have seen a 15-year-long record bull market. Usually bull markets last between 7 to 10 years, so the current bull market has stretched way further than what has been the historical trend. I don't really count the 2020 recession as it was so short and most of the large companies were saved by central banks' quantitative easing liquidity push or government bailouts. If you had a small business, well, then you weren't as lucky. When looking at the current S&P 500 price to earnings ratio, it is around 22, which is on the more expensive side when looking at historical averages, but not crazy expensive. However, in the recent years, S&P 500 companies had record earnings and the earnings growth has surpassed the underlying economic growth. So, at some point, there needs to be a correction as the earnings cannot constantly grow faster pace than the economy. So, we might also be currently in a bit of earnings bubble, and I wouldn't be surprised if we saw a recession, and after that several years until the earnings returned back to 2022 levels. Not saying that it will happen, but there is a good possibility for it. When looking at the Shiller P/E ratio, which shows the current price divided by the past 10 years average earnings, then the current valuations already look quite expensive. Also, if the interest rates stay at high levels for a longer period, then as the 10-year treasury yield raises, It will push stock valuations lower as the risk-free treasury will become more attractive to investors. When comparing current S&P 500 earnings yield to 10-year treasury yield, the difference is less than 1%. Historically, S&P 500 earnings yield has been on average 3 to 4% higher than the treasury yield. I think the market is expecting inflation to be high for a longer period as government deficits are out of control and debt to GDP ratios are expected to rise year over year, which explains the current premium pricing on equities to offer some inflation protection. However, if the earnings yield gap between treasuries and S&P 500 widens back to historical levels, then the S&P 500 can easily crash 30 to 50% from the current level. So, after this 15-year-long bull market run and high valuations, I wouldn't dare to assume any stocks appreciation over the next decade. At least not real appreciation, but if there is a high inflationary period, then there can still be nominal returns covering the inflation, but I wouldn't assume any inflation-adjusted equities appreciation. Third source of growth is net savings from existing customers. For the reasons already mentioned, retail savings rate has skyrocketed during the pandemic, which allowed new and existing retail investors to deploy plenty of cash in the markets. However, as economies are now back open and inflation is hitting customers' purchasing power, the savings rate has plummeted to record lows. It's difficult to make a judgment about what will be the long-term growth rate from existing customers' net savings, as currently these online brokers' average client base is still much younger than the average population. The net savings inflow should be positive for many years ahead. However, over time, as the client base gets older, the capital outflows will also increase. As the customers who hold the most capital are 70 plus years old, the capital outflow rate really depends on how many of these people will be net spenders and how many will be forever savers going to die extremely rich like Warren Buffett. Then, on top of the three underlying long-term growth trends, there are cyclical factors. If we compare the Interactive Brokers and Avanza stock charts with S&P 500 index and VIX index, which represent the volatility expectations, there is a decent positive correlation with both of those. During bull markets, customers' acquisition rate accelerates, and during times of high volatility, there will be spikes in trading volumes. So, in the past 3 years, online brokers have done extremely well. Revenues exploded while the cost stayed relatively flat, which led to industry-wide record profit margins. On the one hand, while these brokers' stock prices are now much more expensive than in the past, these companies are also much stronger with higher customer base, leading to sustainable higher revenues even during less volatile times. However, I don't think profit margins are sustainable at these levels. Either there must be still some decline in trading volumes or more competition pushing the trading fees down. The key is to find out what are the likely sustainable earnings levels for this industry. When comparing these brokers' customer bases, those are quite similar, with FlatexDEGIRO and Interactive Brokers having over 2 million clients, while Nordnet and Avanza have just under 2 million clients each. Prior to the pandemic, the annual customer acquisition growth rate was around 20%, except for Nordnet with slightly lower 15% growth rate. However, after the pandemic, customer growth rates exploded on everywhere else, except with Avanza, as the Swedish investing market is already one of the most mature markets in the world. FlatexDEGIRO's impressive growth numbers are partly explained because they acquired DEGIRO in 2020, which roughly doubled their customers. By the way, if you wonder why the chart goes from right to left instead of left to right, it's because I'm from Europe, so in Europe we like to do things a little bit different, and we are also a little bit dumber here. While the customer numbers are quite similar, Interactive Brokers customers' average savings capital is way higher than the competition, as they do have many professional clients. Since the retail investing boom during pandemic, Interactive Brokers' new customer mix had much higher share of retail investors than professional, which made their average customers' assets fall significantly. FlatexDEGIRO, on the other hand, has very young customer base, with many of them who started investing first time in their life during pandemic, so while their customer growth was impressive, the average customer savings fell from 39,000 euros in 2019 to less than 18,000 euros in 2022, which is 2 times lower than Avanza's or Nordnet's customers' average savings capital. Nordnet and Avanza managed to acquire higher net worth customers during the pandemic, so the average customer assets on these platforms didn't fall as much. While Interactive Brokers and FlatexDEGIRO's customers' growth during the pandemic was impressive, the average savings per new user were much lower, leading to also lower average revenues per user. While customer growth exploded during pandemic, the total customers' assets growth didn't really accelerate. While FlatexDEGIRO grew total savings capital at fastest rate, this chart is not really comparable because they needed to issue new shares for DEGIRO acquisition. So, when we look at customers' savings per share growth chart, Interactive Brokers is leading by 24% compounded annual growth rate, followed by FlatexDEGIRO with 23%. Interestingly, Interactive Brokers grew customer savings capital at faster rate between 2015 to 2019 than during the 2019 to 2022 COVID investing boom years. As customer savings increase, so do revenues. However, it is not totally linear. Prior to the pandemic, the customer savings were growing at faster pace than revenues were. Since pandemic, the trend turned around and revenue growth rate even surpassed the customer growth rate as existing customers started trading more. While the other brokers kept their fees high and enjoyed record revenue growth during pandemic, Interactive Brokers lowered their commissions, even solidifying their competitive advantage. When looking at how much these brokers make revenues against customers' assets, there seems to be a long-term trend of the revenue take rate declining over time. Like in the old days, you could get charged like $50 for trading a stock, but nowadays the stock trading fees in the US are already very close to zero, and in Europe the trading fees have also fallen significantly. So, while customers' asset growth is correlated with revenue growth, keep in mind that the revenue growth rate might be slightly slower than the asset growth rate over time. As the revenue growth accelerated during pandemic, while expenses stayed nearly flat, it obviously led to record profit margins expansion. Nordnet and Avanza had the highest profit margin improvement. On the other hand, Interactive Brokers, which is the most profitable company, lowered their trading fees as the trade volumes increased. FlatexDEGIRO is the lowest margin company as they still lack the scale, while they still offer cheaper trading fees on many products than Nordnet does, for example. Also, FlatexDEGIRO is currently spending about 10% of their revenues into marketing to accelerate growth, which is much higher spending than any of their competition is doing. Over time, I expect there to be some subtraction in the profit margins as either trading activity will decline or there will be more pricing competition. Prior to the pandemic, Interactive Brokers was the only company constantly improving earnings, while others were down or stagnant. However, after the pandemic, the opposite effect happened as Interactive Brokers shared additional profits with their clients while others kept the extra revenues for themselves and saw a massive earnings spike. Avanza is the leading online broker in Sweden with 1.8 million customers. They never had any ambition to expand into other markets, and the goal was to be the best broker in Sweden, which they achieved. They went from around 300,000 customers to 1.8 million in the past 10 years, and even doubled their number of customers from pre-pandemic levels. Average customer savings is 33,000 euros, and total savings capital is 59 billion euros. Estimated 20% of Sweden's population own shares, and Avanza got 70% of Sweden's population as their customers, which majority owns individual shares. So there isn't much room left for additional growth in the stock trading business. However, they started to focus expanding on the pensions market by asking people to move their pensions in Avanza by offering more competitive fees. Average annual fee on pensions in Sweden is 1%, while Avanza is charging on average 0.7%. Now that they have large customer base, they are offering them mortgages as well. It looks like they don't have enough own regulatory capital, so they are acting more like mortgage broker where the financing is from other banks. So margins will likely be very low for them, but it is just additional way to grow revenues without the need for them to commit any capital. However, in the current rising interest rate environment, I expect the growth in mortgages to slow down for a while. When looking at the entire savings capital market, which includes pensions, bank deposits, mutual funds, and shares, Avanza's percentage of Sweden's savings capital market net inflows has been constantly surpassing their existing market share, meaning if the trend continues, they will keep growing their market share. In 2021, they set the target to achieve 10% market share of the Sweden savings market, up from current 6.3%. However, in the recent years, large equity and mutual fund inflows was the main source of the growth, so if that trend reverses, they are unlikely to achieve the 10% market share target that soon. In the fourth quarter, they saw first time in a decade customers' funds net outflow. The outflows were mainly related to one of their asset manager client moving customer funds to its own custody. Without any one-off items, the capital net outflows were still 1 billion Swedish kronas negative. While the commission income fell in 2022 due to lower trading activity, it was still double the 2019 level. However, lower commission income was compensated by higher interest income. From January 1st, Avanza started paying interest on deposits in equity and fund accounts, and the policy is to pass through interest rates above their 1.75% margin to customers. However, that margin still feels quite high, so we'll see if there will be more capital outflows when the banks start offering higher interest rates for deposits. Net interest income supported their earnings in Q4 thanks to the Swedish central bank 2 rate hikes during the period. So far, the banks in Sweden are not sharing any interest on short-term deposits and keeping all the profits for themselves. However, at some point, when one bank decides to add additional market share and pass some interest to customers, others are forced to follow, so it is just a matter of time until interest margins will narrow again. When valuing the stock, I need to know customers' total savings capital, what percentage of revenue they can make annually against their customers' assets, what will be the long-term net income margin, what is the customer's assets annual growth rate, how will the revenue take rate from customers' assets change over time, and finally, how do they allocate profits. Then, as I estimate all of these metrics, I can put them in my discounted earnings valuation model to estimate the fair value and likely long-term return for the stock. Avanza's customer savings capital is 59 billion euros. As I explained earlier, after the record bull market and currently high valuations, I'm expecting zero returns from equities over the next decade. I'm assuming that the average equity valuations will be 10% below the current levels over the next decade, and after that the equities will start appreciating at 5% annual rate. Avanza makes on average 0.45% annual revenues against their customers' assets. Profit margins are currently on the high end due to recent explosion in trading activity and new customers, so over time, when trading activity slows down and competition increases, I'm expecting the margins to come down a bit, and I'm assuming long-term net income margins to be around 40%. As Avanza is already known by almost everyone in Sweden, and out of approximately 2 million investors who invest in individual stocks, more than half are already investing through Avanza's platform, so I don't think there is much room to take away competition market share in stock trading business anymore. Their customer base tilts more heavily towards younger generation, so if the next young generation starts investing at same pace as the currently 30-year-olds, it will lead to naturally around 3% annual customer growth. However, the new customers also bring less capital and less revenues to the platform, so the 3% annual customer growth should lead to around 1% annual revenue growth. Then, on top of the customer growth, there is still plenty of opportunities to grow in pensions, mortgages, and deposit side, so I'll give them additional 2% growth on these areas, leading to a total of 3% growth rate from new customers. I'll expect this growth rate to be there over the next 3 decades. Then, the last pillar for growth is from existing customers' net savings. This will vary a lot depending on economic cycles and stock market performances. Also, as the 70 plus years olds are the wealthiest clients, the total net savings rate will depend on how many of these investors will be taking capital out of their portfolios and how many will be forever savers that are going to die rich. Currently, average customer savings are still only 33,000 euros, so majority of the clients are at the beginning of their investment careers, and only modest capital inflows will make a significant difference there. I'm assuming average 5% growth from capital inflows over the first decade, which would average 138 euros per customer per month. Then, after each decade, the growth from capital inflows will decrease by 1%. If you have a different point of view regarding to capital inflows, let me know in the comment section. Then, there has been a long-term trend of trading fees getting constantly lower and lower, and I have no reason to assume why this trend wouldn't keep going into the future. So, I'll factor this trend inside my valuation model by assuming that the revenue take rate from customer assets will decrease by 2% annually. Regarding to capital allocation, they pay out 70% of net income in dividends. Rest is probably needed to strengthen the balance sheet to support future growth. I'll assume the dividend payout ratio to be 70% over the next decade and then going up to 90% after. I never expect the payout ratio to go all the way to 100%, as they will always need some additional cash for regulatory requirements. Finally, they do have 209 million euros of excess cash on top of their regulatory requirements. They will likely just keep it on the balance sheet to have some extra buffer for capital requirements and to support the future growth. However, if there are some opportunities, they could use part of it to do strategic buybacks or business acquisitions. So, as there is the potential to use it, I don't totally disregard the excess cash, but I'm going to discount it heavily by using 50% discount rate. So, based on these inputs, for a 10% discount rate, I'm getting net present value of just over 2 billion euros compared to the current market cap of 3.8 billion euros. So, from my valuation perspective, there is a 45% downside potential in the stock price. Also, note that this is a pre-tax valuation. To get the valuation for 10% after-tax return, you must deduct your tax rate from the dividends. If you want to calculate your after-tax return valuation, you can get quite close to the correct valuation by just deducting your tax rate from this pre-tax net present value. Currently, Avanza seems to be fairly priced for a 7% annual long-term pre-tax return. Interactive Brokers is personally my favorite investing platform. They offer the broadest market access from any retailer brokers globally with a very competitive trading fees, and they absolutely crush the competition with low margin, low rates, and by giving people access to currency spot market. They provide by far the lowest margin, low rates and currency exchange fees in the industry. On top of the low trading fees, Interactive Brokers' smart routing algorithm finds better execution prices for trades than the industry average. Customers can also opt in to trade totally without commissions in the US stock exchanges. However, if you opt in for commission-free account, then Interactive Brokers will sell your trading data to third parties. If you opt in to pay a little bit of commissions, then your data won't be sold, and you will get better execution prices. Even many commercial banks and online brokers are using Interactive Brokers platform to execute their customers' orders as the pricing is so competitive. Despite of the low trading costs, Interactive Brokers' profit margins are the industry leading thanks to their highly automated platform. They are operating globally with clients in more than 200 countries. About 3/4 of their clients are from outside of the USA. The client base consists of professional and individual clients. Individual clients make about 55% of their commissions, while hedge funds, mutual funds, financial advisors, and proprietary trading groups make 33% of commission revenues. Then, the rest consists of introducing brokers. Those are brokers who opt to let interactive brokers to execute their clients' orders and be custodian of their clients' funds, but they do provide the customer service and pricing to their clients for themselves. Still, half of the commissions are from the US, followed by second biggest market of Asia Pacific, while Europe is accounting about fifth of the commissions. Interactive brokers pays extremely competitive interest rates for customer balances, just 0.5% below the central bank's benchmark rates. Currently, they are paying higher interest for customers' balances than the banks are paying in Europe. So let's move to the valuation model. Customers' equity was 286 billion euros by the end of 2022. So I'm assuming equities to be on average 7% below the current level over the next decade, leading to 257 billion euros balance on average. I'm assuming interactive brokers to make on average 1% annual revenues against their customers' equity balance. The historical average was higher, but their revenue take rate has been trending down, so I'm using 1%, leading to just over 2.5 billion in revenues. I'm expecting average net income margin to be around 45%, leading to net income of 1,158 million euros. Interactive brokers is attracting larger chunk of professional clients, and the average client equity is 137,000 euros compared to 33,000 in Avanza. Since 2019, they increased their total customer base by 3 times to currently over 2 million. However, the new clients are on average much smaller, and the average equity per client has fallen by 39% from 225,000 euros in 2019. Management is expecting natural word-of-mouth customer growth of between 10 to 20% depending on economic cycles, and then additional 10 to 20% growth from their sales efforts, leading to total annual customer growth rate between 20 to 40%. As they are operating globally in many high-growth countries, and they offer by far the best market access with the most competitive pricing, I'm expecting them to grow faster than the industry on average. Even during times when overall market isn't growing, I still expect interactive brokers to grow by stealing competition market share. However, as we've recently witnessed the crazy investing boom, my expectation is for the next decade customer growth to slow down a bit, and I'm assuming average client growth rate of 25%. The new clients on average bring significantly less revenues than existing clients. However, lately interactive brokers has been building up their balance sheet in order to attract some large hedge funds joining their platform. So if they are successful by acquiring more hedge fund customers, then the average client size will increase significantly. I'm rather more conservative, and I won't assume them winning too many Goldman Sachs and Morgan Stanley's clients, but still, I believe significant part of the customer growth will be on hedge funds, proprietary trading groups, and financial advisors, leading to annualized revenue growth rate of 10% with their 25% customer growth rate over the first decade, and then gradually slowing down. For the first decade, I assume on average 0% appreciation on equities, and after that, equities will appreciate on average 5% annually. Then, as the average account balances are already higher on interactive brokers than competition, I also expect the annual net inflow to be lower, being 3% annually for the first decade and slowing down 1% each decade after that. 3% inflows equals to 342 euros average monthly contributions. Over time, I'm expecting the revenue take rate to fall 2% annually. It will lead to combined growth rate of 11% over the first decade. Regarding to capital allocation, interactive brokers has been hoarding cash on their balance sheet for years. Currently, excess regulatory capital is around 8 billion euros. However, they will keep it on the balance sheet to attract large hedge fund customers who need to see strong enough balance sheet before they consider joining the platform. So, unfortunately, all of this excess cash will just sit on the balance sheet and don't expect it to ever be distributed towards shareholders. That's why I'm using 100% discount rate for the cash balance, discounting it to zero. Currently, they are paying only 160 million euros, or only about 10% of the earnings in dividends, and when asked about distributing cash towards shareholders, the founders state very clearly that they will not increase dividend and will keep hoarding more cash in the foreseeable future. On a positive note, if they fail on their targets to acquire large hedge funds, at least there is 25% of the current market cap just sitting in excess cash on their balance sheet. So, if the growth plan fails, at least investors might be then rewarded with this cash. So, even though Interactive Brokers' valuation relies heavily on growth rate assumptions, this cash balance will somewhat decrease the risk. So, the annual growth rate will be 11% over the next decade. After that, customer growth and capital inflows will slow down gradually, but 5% annual equities appreciation will keep the growth rate still at 30% over the next 5 years until it will gradually slow down. Dividend payout ratio will be only 10% for the first decade, and then increasing to 50%, 70%, and finally to terminal 90% dividend payout ratio. Surprisingly, even though the dividend payout ratio is still irrelevant, and I discounted all of the excess cash to zero, Interactive Brokers still seems to be very close to fair valuation for 10% annual return, as the net present value is around 30 billion euros compared to the current market cap of 34 billion euros. So this is already interesting. However, the valuation model is still too dependent on long-term growth assumptions and on the assumption that Interactive Brokers is able to maintain their dominant market position and leading profit margins. For example, let's just assume that annual growth rate will be 3% lower and there will be tougher competition in the future, pushing the net income margins to only 30%. It would push the net present value down to just under 10 billion or 71% below the current market cap. However, maybe in this situation, they could use 50% of the excess cash in buybacks and then increase dividend payout ratio, leading to a valuation of just under 19 billion euros, but it is still a 45% drop from the current market cap. Of course, if the growth rate is faster, let's say 3% faster than predicted, and then also net income margins are 60% instead of 45%, then there will be the same effect towards upside, and it would make the net present value to be almost 90 billion euros, and there would be a 161% upside on the stock price. So, while I think Interactive Brokers is currently fairly priced, their return depends too much on the future growth predictions going beyond decades, which makes it too risky buy at the current price. I'd rather wait for a larger discount so that there is a limited downside potential with a higher upside. FlatexDEGIRO is the fastest growing European online broker, operating in 18 countries. Compared to other brokers, FlatexDEGIRO is making much larger chunk of their revenues from commissions rather than interest income. Their clients are using only 1 billion euros worth of margin loans, which means the average customer leverage is just 2.5%. So, on the one hand, there is more growth potential on the margin side, but on the other hand, the currently low margin levels indicates that the client base is more conservative and it is not just full of gamblers speculating in the recent bull market. Internal costs per trade are down from 1.44 euros in 2019 to currently only 50 cents per trade. Still, even after the cost reduction efforts, FlatexDEGIRO is the least profitable of the brokers compared in this video. However, it is partly explained by them spending about 10% of revenues into marketing, which is by far more than what their competition is spending. It makes sense as they are operating in multiple high-growth markets and they are getting great returns for their advertisement. Average customer acquisition cost is 60 euros and the payback period is less than 5 months. While Avanza and Nordnet operates in already mature Nordic markets, FlatexDEGIRO is also operating in 285 million people growth markets, where only 8% of the targeted population currently do have online broker. So, if they execute well, they should grow over time at faster pace than the Nordic competition. Currently, they are outgrowing all the European main competitors in customer acquisition combined. The longer the customer stays on the platform, the higher the revenues become. And churn rates are solid, with 69% of their 2014 customers still staying on the platform today. Their customer base is the youngest from the brokers I'm comparing, which means that the average assets per customer are low, but if they can keep the current customer base in the platform, they will grow at fastest pace. As the customers' assets grow over time, so do revenues. Revenue growth is not quite linear with the asset growth, but with a clear correlation there. Highest revenue growth in customers is between ages from 18 to 44. However, even though these customers are young and less wealthy, I think the client's quality should be decent. Most of the COVID stock market boom gamblers with no prior experience of investing, who just wanted to speculate in meme stocks, cryptocurrencies, and to take high leverage bets, went into platforms like Trade Republic, eToro, and Trading212 in Europe. Those are the Europe's equivalent platforms of Robinhood in the US. In the earnings call, the CEO joked about that while FlatexDEGIRO advertises on places like Reuters and Bloomberg, these other platforms advertise on places like TikTok. The trading activity has normalized in Q3 from pandemic levels. When comparing FlatexDEGIRO's customers' trading activity to Avanza's and Nordnet's customers, it is pretty much in line with them. Avanza and Nordnet are the highest quality online brokers in Europe, so it is another indicator that FlatexDEGIRO's customer base should be decent. Adjusted EBITDA is down, but still on solid levels. When looking at the 2021 income statement, their long-term variable compensation cost was almost 60 million, which is more than their entire net income for the year. At first glance, it looked very bad. However, it wasn't a cash cost, but the provision set aside for a long-term compensation plan. They issued stock appreciation rights to the management in 2020, and the compensation amount will be 50% dependent on stock price and 50% on the earnings per share. As both stock price and earnings skyrocketed in 2021, they increased the provisions for the plan. However, as the stock price fell in 2022, the provisions were already adjusted down by 20 million. The provisions are just accountants' educated guesses of what the compensation might be, but the management will only get paid by 2026. So, if the stock price and earnings are high in 2026, then the compensation is high, but it is also good for us. If they don't do well, the management won't get paid much either. Based on 2.5 billion liquidity portfolio and assumption that European brokers won't keep passing interest to customers, there is 62.5 million additional earnings before taxes potential at current 2.5% ECB depository rates, and the rates may keep rising later this year, leading to even more possible profits. Currently, in Europe, all the brokers and banks want to keep majority of the interest benefit for themselves, and there hasn't been any competition so far for customer deposits. However, at some point, when the competition increases, they will be forced to pass majority of the interest rates to their customers, or otherwise customers will keep their deposits elsewhere. Still, in the short term, rising interest rates will offer nice earnings boost, but it is absolutely not going to be sustainable. The 2026 vision is to have 7 to 8 million customers, up from current 2.4 million. It is very unlikely to happen, as customer acquisition has already slowed down significantly, but by 2030 they could achieve that target. They also want to increase adjusted EBITDA margins above 60% by then. When you compare it to prior year's earnings, excluding the temporary high marketing expenses, it's not that crazy target, and as they achieve more operating leverage, they could hit the 60% adjusted EBITDA margin target. However, the competition may also be tougher in the future, with companies like Interactive Brokers focusing more on capturing retail market share. So, in my valuation model, I'm not going to assume them hitting these targets. If they achieve their target to have 250 to 350 million transactions and 1.5 billion in revenues in a year with low market volatility, Then let's assume improved 40% net income margins, and it will lead to 600 million in net income compared to the current market cap of 800 million euros. There is the 20x upside potential for this stock. I don't think these plans are realistic, but then the stock is already priced so low that they don't need to even get close to these targets in order for you to get good returns on this investment. So for the valuation model, I'll assume 0.8% revenue take rate from customers' assets. Currently, customers' assets are 42 billion euros, and again, I'm expecting no equities appreciation over the next decade. And I'll assume the equities to be on average 10% below the current valuations over the next decade, leading to customers' asset balance of around 38 billion euros. With the 0.8% revenue take rate, it will lead to 300 million annual revenues. I'll assume the net income margins to be 20%. Long-term net income margins could easily go to 40% as they achieve higher operating leverage, but I wouldn't dare to assume that on my valuation model. So I stick with 20% net income margins, leading to net income of 60 million euros. Customer growth rate between 2015 to 2022 was 45% annually. However, the DEGIRO acquisition really boosted those numbers. Prior to acquisition, Flatex grew at 20% annual rate. Currently, management says that even during down markets, they should increase 400 to 500,000 customers annually, which would be close to 20% growth rate. However, the growth rate seems to be already below that level in Q3 2022. I'm going to be a bit more conservative than the management, and I'll assume customer acquisition to average 12% annually over the next decade, and then slow down. As the average customer savings are already quite low, only around 70,000 euros, the new customer additions, even though they will likely be on average less wealthy than existing customers, shouldn't bring the average customer size down that much. So I'll assume that the 12% customer growth rate will lead to 6% annual revenue growth rate. No customers' assets appreciation over the next decade, and after that 5% annual appreciation. Net inflows from existing customers will likely be higher than competition in percentage-wise, as FlatexDEGIRO has the lowest average assets per customers and youngest customer base. I'll assume net inflows to be 6% annually, meaning that on average customers will deposit 88 euros monthly into their accounts, which in absolute terms is still much lower than their competition. Then each decade the net inflows will decrease by 1%. Then, as FlatexDEGIRO's customers' assets grow over time, I believe the revenue take rate, which is currently higher compared to Avanza and Nordnet, will decrease at slightly faster rate of 3% annually. Regarding to capital allocation, currently they do have something around 50 million euros of excess capital. There was recently a regulatory audit on them, and they were reporting their risk-weighted margin loans default risks the wrong way, so they will need to keep the excess cash in the business until the reporting is fixed. After that, they should have around 50 million excess capital, but it is likely going to be used on the balance sheet to support the future growth. So I'm just going to discount that cash with 100% discount rate. Till today, they haven't paid out any dividends to shareholders. However, the management is planning to start distributing profits to shareholders in a couple of years if the environment is right for it. So I'll assume that they will need to keep some profits to support their growth plans, and dividend payout ratio could be around 50% over the first decade and then go up after that. So combined growth rate for the first decade is 8%. After that, when I take into account the 5% annual equities appreciation, the growth rate climbs to 11% over the next 5 years, and then the growth rate keeps declining by 1% every 5 years. Dividend payout is 50% in the first decade, going to 70% after, and then up to 90%. It will lead to net present value of 1.6 billion euros, which is double of the current market cap. Or if you increase the discount rate, then the stock will be currently fairly valued for 13.5% annual return. On top of that, I was, in my opinion, a bit conservative on my growth rate assumptions compared to the other brokers I valued. And net income margin is only 20%, but it could easily go to 40% over time, already doubling the valuation. If the management executes their 2026 vision, which I don't think they can do, but if they did, the stock would likely go up 20 times from the current levels. So there is definitely upside potential. If instead I lower the growth rates by 3% annually, the stock will be still fairly priced for 10% annual return. So there is some room to be wrong on the growth assumptions and still make decent returns. Nordnet is the leading broker in Nordic countries by Nordic Stock Exchange trading volumes. They are the market leader in Finland, Norway and Denmark, and the second largest broker in Sweden. Currently, almost 1/5 of the stocks in Nordic countries are held in Nordnet. Also, nearly 1/5 of the population owns individual stocks. As these markets have been getting more mature, there is less growth opportunities left in the stock trading business, but there is still plenty of room to grow in funds, deposits and pensions. Here you can see the revenue breakdown by country. Revenues from Norway are the most profitable, as in the recent years, their growth skyrocketed in that country. Nordnet managed to grow customers even during the 2008 recession, as online brokers were still brand new in the market and they kept stealing market share from traditional banks. However, now as the online broker market is more mature, going forward, I would expect it to be difficult to grow customer numbers during recessions, or there might be even some decline. The recent investing boom had the most positive impact on Nordnet's margins, as they more than doubled revenues while operating expenses stayed almost flat. As these online brokers accelerated the growth rates by stealing the traditional bank's market share over the past 20 years, I just wonder how much more room there is left for additional growth, as everyone already knows them. I think going forward, the customer growth will mainly just come from the next young generations choosing to invest more in online platforms. In Sweden, which is the largest market, customer growth already stagnated in 2022 and small decline in revenues. In Norway, they make by far highest profit margins as the customer growth exploded during the pandemic. However, in 2022, growth already slowed down significantly. Similar story in Denmark with impressive growth, but their revenues are already down in 2022. Finland was already growing fast prior to the pandemic, but then the COVID investment boom growth wasn't quite as aggressive there as in other markets. In Finland, there isn't any other online trading platform with local language customer service than Nordnet, so it has been historically very easy market for them to grow. I'm actually surprised they are not more profitable in Finland, as trading costs are quite high. For example, buying a US stock from Nordnet will cost Finnish customers 15 euros plus currency exchange fee on top of that. Also, customer growth rate slowed down in 2022 and revenues were down. Historically, before the investing boom, net savings inflows have increased customers' assets between 5 to 10% annually. Nordnet's existing customer base is peaking at the 30-year-old customers. Still, they do have plenty of over 45 years old higher net worth customers as well. Nordnet also has higher number of passive investors who never trade and mainly just put money on low margin ETF products. In the fourth quarter of 2022, less than 30% of clients made trades. That's why Nordnet and Avanza are making less revenues against their customers' savings than FlatexDEGIRO or Interactive Brokers. If there won't be competition from deposits in 2023, Nordnet estimates making 1.8 billion Swedish kronas of income only from the liquidity portfolio. In 2022, they made total operating income of 2 billion kronas, so only the liquidity portfolio would generate almost as much profits as the entire business made in 2022. However, like I said earlier, this will boost the short-term profits, but at some point there will be more competition from customer deposits in Europe, and then the brokers will need to start passing through some interest to their clients. So currently customer savings are 64 billion euros. I'll assume that the stock market will be on average 10% below the current levels over the next decade, leading to average balance of current customer savings of approximately 58 billion euros. I expect the revenue take rate to be 0.55%, leading to revenues of 317 million. Average net income margins will be 30%, leading to average earnings of 95 million from the current customer savings capital over the next decade. Then I expect customer growth rate to be 3% annually in line with Avanza, but the revenue from new customers will likely be around 3 times lower, leading to annual growth rate from new customers of 1%. However, as they are also expanding in pensions and mortgage lending, I'll expect it to accelerate growth rate for additional 2%, leading to total growth rate of 3%. Over the next decade, I assume average 0% annual stock market appreciation, and after that, the stock valuations will grow at 5% annual rate. Customers' net inflows should be in line with Avanza, and I assume it to be 5% annually over the first decade, and then to slow down by 1% each decade after. It is in line with Nordnet's historical customer inflows between 5 to 10% prior to the pandemic investing boom. However, previously a large chunk of the inflows were people moving their assets from traditional banks to Nordnet, and going forward I expect less of that, leading to slightly lower annual net inflows. As the customer savings is not linearly correlated to revenues, and over time the revenue take ratio has been trending down, I expect that going forward the revenue take rate from customers' assets will decrease at 2% annual rate in line with Avanza. Nordnet is currently paying out 70% of earnings in dividends, and the rest are used to strengthen the balance sheet. I assume the 70% dividend payout over the next decade, and then increasing the dividend payout to 90% after. So the combined growth rate will be 6% annually over the first decade. Then it will actually increase to 9% over the next decade, as I include average 5% stocks appreciation, and after that the growth rate will steadily slow down. They also do have 350 million euros of excess cash, which will likely be mostly kept on the balance sheet to support the future growth. But they could use some of it for strategic buybacks or acquisition if there was an opportunity for it, so I'll discount it with a 50% discount rate. I'll get a valuation of just under 2.3 billion euros compared to the current market cap of 4 billion euros, which leads to 44% downside potential. Nordnet is currently fairly priced for 7% annual return. Out of these brokers, Robinhood stock price has declined the most, currently trading at $8.5 billion market cap. They were the first broker to introduce commission-free trading and were the pioneers of the industry, which led to extremely fast account growth. The commission-free trading is financed by brokers selling their customers' trading data to high-frequency trading companies, who then trade against those clients and make a tiny profit for themselves against each trade. So customers who make very low dollar-sized trades save some money, but for bigger clients the commission-free trading model actually becomes more expensive, as the spread they lose by slightly worse order execution prices exceeds the traditional trading commissions. However, Robinhood does no longer have the cost edge because all of the major competition in the US started offering the option to trade without paying commission against their order data. But while all the competition is making massive profits, Robinhood is losing about $1 billion annually, and their operating income margin is negative 75%. It's funny, when you look at Robinhood's consolidated income statement, there is a line item called Technology and Development where they spent almost $1 billion last year. When I looked all of the competition financial statements, the technology and development expense was so insignificant it wasn't even disclosed as a separate line item. So, as Robinhood is spending much more money on technology and development than their competition is, you would assume that they are the technology leader. However, the truth is exactly opposite. Robinhood has the worst product offering amongst the competition. The technology and development cost mostly just consists of their employees' stock-based compensation and salaries, and in reality it doesn't have much to do anything with actual technology. But okay, if they can scale up revenues, maybe they will reach profitability eventually, right? Well, I don't think so. Robinhood's customer base is full of new investors, and many of them were just gambling with meme stocks and options during the market boom, but are not really suitable for long-term customers. I don't think there are many high-quality customers in Robinhood's platform, as they prefer to trade with more reputable brokers who also offer commission-free trading and have better product offerings on top of that. Robinhood really destroyed their public image in early 2021 when the Reddit Wall Street breadcrumb was buying GameStop stock like crazy in order to short squeeze some hedge funds who had built way too large short positions into the stock. The Reddit army was very successful doing so until Robinhood decided to freeze all the new buy orders in GameStop stock. Some of the hedge funds who had massive shorts in the GameStop were Robinhood's clients, as they bought Robinhood's users' trading data, so there was a clear conflict of interest, and it was against Robinhood's management's own self-interest to let those hedge funds go bankrupt. Robinhood, of course, denied that they wanted to protect the hedge funds, and they had their own reasonings, which I cannot even remember anymore. In the end, whatever the truth was, Robinhood destroyed their public image, and when you are holding people's money, your most important asset is your public image. As you can see, the new account growth stopped like a wall after the first quarter 2021 GameStop event, and the trading volumes are trending down quarter over quarter. Also, there were other incidents destroying their credibility, like when the CEO claimed that their savings account were insured by Securities Investor Protection Corporation, while it wasn't true. I don't think I need to waste any more time looking at Robinhood. In conclusion, they no longer have the commission-free trading advantage, as all of the competition is also offering commission-free trading, and Robinhood is burning cash, while all of the competition is extremely profitable. Then on top of that, they destroyed their reputation, account growth stopped like in a wall, and trading volumes are constantly decreasing quarter over quarter. If you are thinking, should you short Robinhood stock? My answer is maybe. However, personally, I'm not interested doing that, because when I'm looking at their balance sheet, the shareholders' equity is $7 billion, of which around $6.5 billion is net cash. Compare that to the current market cap of $8.5 billion, and they are trading very close to the net cash value. I don't think the stock valuation will ever go below the net cash value, so if you open a short position on Robinhood, it will be a very long and slow short, as the stock price will likely decline in line with the annual cash burn rate. Then you have to also consider what is the cost of borrowing the stock for the short sale. Doing likely a multi-year long short sale in Robinhood stock isn't something that I'm interested. On top of that, if they somehow do a miracle and turn the business around, it can go up easily by 300 to 500%. I think there is less than 1% chance for that, but you never know. I personally do have account in Nordnet, DEGIRO and Interactive Brokers, so I'm ranking these platforms based on product offering, trading and margin cost, and user interface quality. Nordnet does have the least stock exchanges available on their platform. DEGIRO does have the second broadest market access, and Interactive Brokers does have by far the broadest market access, including all the major global stock exchanges, and the ability to buy almost any investment product you can imagine. Looking at the trading and margin cost, Nordnet unfortunately loses again. DEGIRO does have overall slightly cheaper trading cost, depending on the product category. DEGIRO also does have slightly better margin borrowing rates than Nordnet. However, Interactive Brokers absolutely crushes both Nordnet and DEGIRO by offering overall much cheaper cost in trading, margin loans, currency exchange, and they even pay extremely competitive interest for customer deposits. In terms of user interface, Interactive Brokers may be too complex for new investors, but then the user interface gives more options for professional investors and traders. So, for the new investors, Nordnet and DEGIRO wins, and for the experienced investors, Interactive Brokers is the best. Based on my valuation models, Interactive Brokers is fairly priced, currently offering around 10% pre-tax return. Nordnet and Avanza, on the other hand, looks a bit overvalued for a 10% return, and there is a 44 and 45% downside potential based on my valuation model. FlatexDEGIRO seems to be the most undervalued stock, with 13.5% pre-tax return or 100% potential upside for the valuation with the 10% discount rate. I cannot tell with the high certainty what the growth rates will be or if these brokers can maintain the high margins into the future. Also, the growth won't be linear, so if we go into recession and then trading volumes fall, it will probably push these stocks' valuations temporarily to much lower levels. However, when I compare Nordnet stock to FlatexDEGIRO stock, Nordnet is trading at price to earnings of 26, while FlatexDEGIRO is trading only at price to earnings of 11. On top of that, FlatexDEGIRO is operating in markets with much more growth opportunities left, and the average savings capital per customer will most likely grow at faster rate as the customer base is still younger. Then Nordnet's net income margins were already 41% in 2022, while FlatexDEGIRO's adjusted net income margins were only 21%, meaning that FlatexDEGIRO has much more growth potential from margin improvement over time as they achieve better operating leverage. On top of the lower valuation and higher growth rates, FlatexDEGIRO, in my opinion, simply has better investing platform as they offer broader market access with slightly lower trading fees and lower margin borrowing rates. So, based on that, I decided to open long position on FlatexDEGIRO and a short position to Nordnet stock. I don't know if the online broker stock valuations will go up or down in the short term. However, I believe over the long term the valuation gap between FlatexDEGIRO and Nordnet will narrow. If you wonder why did I choose to short sell Nordnet instead of Avanza, the reason is simply that I'm personally Nordnet's customer, so I know the product better, which also makes me more comfortable shorting it. Thank you for watching the video, and if you have any comments or questions, let me know in the comment section. Bye.